Here we are, live at 5 on a Thursday for our happy hour in the ETF think tank. Thrilled to have everybody here. I see some people coming in, which is great. We've got a wonderful guest, Erin Arvedlund here. And with that, by the way, I'm Dan Weisskopf, the ETF professor and also lead ETF strategist for the ETF think tank, and of course, portfolio manager at Tidal Financial. With that, I'm going to hand it off. Who wants to catch it, David or Cynthia?
I'll take it next. Much shorter introduction. David Chikansky here, fellow PM under the Tidal Financial Group umbrella, focusing on the SoFi Beer and Boss Gig Economy ETF and Amplify Inflation Fighters ETF IWIN. I'm very excited to hear from Erin today. I'll pass it on to Cynthia.
Hey everybody, Cynthia Murphy, head of research for the ETF think tank. Thanks for joining us as always, and thanks for everybody who's brave enough to turn on your cameras and join us on screen here. Erin, I'll pass it to you. You want to introduce yourself to everybody?
Sure. My name's Erin Arvedlund. I'm the author of Too Good to Be True, Rise and Fall of Bernie Madoff. Very happy to be here. I've known Dan for a long time. He was the one always telling me ETF structure matters.
He hasn't changed.
And yeah, and he very kindly invited me on today because there's a new movie out about Madoff called The Monster of Wall Street.
I thought it was about you. And now you broke the story. And by the way, you have 2 books out. You forgot about one. Right?
That's right. The second one was so boring. It was about LIBOR. That even my mom didn't read it. It's called Open Secret. It was about the rigging of interest rates, the LIBOR rather, during the financial crisis. But thank you.
Of course.
Well, tell us before you jump in, then tell us how this movie that's coming out on Netflix, how are you connected to it? How has your work contributed to it? Connect that dot for us.
I was contacted by the Monster of Wall Street director, Joe Berlinger, about a year ago. Actually, it was about a year and a half ago. I thought, I didn't know who he was. I'm not clueless. I thought he was kind of a crazy guy. I thought, oh, here's another, Madoff conspiracy theory person who wants to make a movie. But it turned out he was a legitimate director. He also has another movie out right now about Ghislaine Maxwell. So he asked me to kind of reprise what happened, and who some of the major players were. And strangely enough, the movie came out just as FTX collapsed, and I think there are many parallels. So I was surprised to see it came out like maybe a month or 2 after the collapse of FTX, and here we are.
Do tell, what parallels are you thinking about? I was thinking, by the way,
yeah,
our drinking word is fraud.
Oh,
So-
yes.
Cheers.
Cheers to fraud.
Cheers. Well, I don't know about that one. Yeah.
The statement was not compliance approved.
And yeah, the FTX thing, David was asking me if I had any inkling it was coming, and the answer is no. But I will say the fact that Sam Bankman-Fried was sloshing money back and forth between, Alameda Research and, the trading platform, and was doing all these, I don't know if you've seen any of the bankruptcy filings, but he was like doing all these round trip deals with hedge funds and venture funds saying like, you give me 200 million buying token, I'll turn around and give that money right back to you in your fund. So yeah.
Yeah, and you elaborated before the call on this. So this was, if I'm not mistaken, you said like trying to get leveraged synthetic positions on stocks that were somewhat illiquid.
Yes. In fact, if anyone's listening on this call and they know anything about it, I would love to hear more. So the chatter is that just like the Madoff fund investments that were leveraged, there are apparently some folks some hedge funds that were using FTX to create synthetic short positions. The mechanics of that, I don't understand. I would love to learn more.
Honestly, they're probably just using the options market to make synthetic short positions, and FTX was just the platform of maximum leverage on almost any asset class, right?
Yeah, but also did not have to be reported.
Right.
And I think there was a question of like, if there's a failure to deliver, is it like a legitimate, basically, was it unregulated? And probably the answer is yes.
Well, did the trade really exist? Is the other part, right?
Correct.
Yeah.
Well, the trade existed, right? But the assets in the platform were not owned by the registration of the account owner, right? It was a pooled asset that was then leveraged as a pool asset. So the trade was actually there, like the synthetic positions were there, that's doable.
Right.
Who actually owned it? That was the question. So I honestly, like, good for those hedge funds. They got their hands stuck in the cookie jar, like it's their own.
Someone just asked in the Q&A, the name of the book was Too Good to Be True, The Rise and Fall of Bernie Madoff. And again, I was as stunned as anyone when I got the call from the film director, Joe Berlinger, because let's face it, this happened 15 years ago. But it just keeps happening over and over. And there are some estimates that the FTX collapse might be multiples of Bernie Madoff. Precisely for that reason, David, because we don't know who had those positions.
So do you think it's because all this fraud, cheers everybody, is it to your point that it keeps happening over and over again? Is it because it's impossible for regulators to keep up with the amount of possibilities? Is it because the loopholes are always there and criminals are just really smart? I mean, why are we so challenged in learning some lessons here?
A brand new crop of retail investors might be one answer. I mean, we saw during the pandemic how many millennials started jumping into the market, trading, on their phones. And I think it was a brand new asset class with no regulation.
I'll add to that there were people who were transitioning initially from sports betting to stock investing, right? Because all sports ceased to play for a little while, and they were sitting there home. They're like, "What do we do now?" And they're like, "Well, you can do this on Robinhood for very cheap." So,
yeah, yeah. I mean, how did sports betting become legal overnight? How did that happen? And we had all the stim checks coming in. There was new money flooding into the market. So, that's my best guess.
Can you tell us, how you first got the whiff about the Bernie Madoff story? How do you find that thread and what led you down that path? A little bit about that, the story behind it.
Of course, yeah. At the time, this is in 2001, when I am so dating myself. I was covering the options market, and I got a phone call from a very good source of mine who worked at Deutsche Bank. He's in the book. His name's Ken Nakayama. He was an equity derivative strategist at Deutsche Bank and he wanted Bernie as a customer. He wanted to trade with Madoff. Excuse me. So,
Hi, Patrick.
Hello. This is his first public appearance. So I got that call from Ken, and he said, "I will do some due diligence if you can start making some phone calls." And that's kind of how we got started. And then I talked to a bunch of private bankers, the Fairfield Greenwich feeder fund to Madoff. And there were a couple of firms that wouldn't touch him. Solomon Brothers, then part of Citi, Goldman Sachs. And yeah, so it was very strange because a few people raved about him, and the others said, I can't make heads or tails of this do any due diligence. I'm not touching it. So it was really all over the map. So Barron's wrote a story in 2001 questioning his returns, and the story came out and basically nothing happened. And then 7 years went by. And as we all remember, in 2008, the crisis happened. I'm going to mute myself.
No, you can't mute yourself. That's not allowed. He's
So,
fine.
Okay.
And
He
if I
doesn't drink,
recall,
by the way.
there was a specific month in the fall of 2008, September, October, this like massive drawdown month in the market where everything was down like 8 to 10%. And then Bernie printed like the same monthly return as he always did. And that's like, wasn't that like the one specific event that kind of like really called bullshit? It was like October 2008.
Yeah, he got $8 billion worth of redemptions in November of 2008. And of course couldn't meet them. So I think that was part of the reason why he fessed up, was he kind of knew the game was over. And
he didn't have Blackstone's playbook from Beery to just let in Southern California into that. So
yeah, well, that was one of Madoff's big attractions, was he promised 30-day liquidity.
Yeah.
And right. And had never had a problem meeting it. And then, of course,
what's amazing is the 7-year window. Like I read some interview he gave, and he himself, when the articles came out, he mentions your name, saying he was waiting for the SEC to come knocking on his door, and nobody ever came. And so, which to me is the amazing part of the story too. It took 7 years for anybody to really look into it.
Yeah, the SEC had come and they had actually done a couple of examinations. The last one was in 2006, and they had kind of at that point figured out that he had this family office or hedge fund or advisory business, and they said, you've got to register. So, which essentially, I guess he filled out a form, and that was it. And, at that point, I think they got the closest that they ever got, because one of basically his right-hand man, Frank T. Pasquale, said, okay, I'm going to go print out some fake statements from like 1982, backdate them. And then he actually had to throw them in a fridge because they were still hot from the printer. So like that was the extent of the fraud that they were going to. Cheers.
Yes.
So I want to, we can talk about Madoff for hours, I'm sure, but let's talk about a little bit about the situation in Florida, because there are a bunch of portfolio managers on this call who are more than capable, but definitely willing to manage $230 billion. I'm up there. Okay, I'm definitely. Talk to us. It just kind of broke. I wasn't aware of it, but I definitely sent my bio in.
So Florida Governor Ron DeSantis needs to select a very high profile position. They are searching for the top investment manager overseeing $230 billion. Just this week, they put out the job description. I will post that in the chat because it is one line. And they said essentially, send in your CV. No qualifications, no job description. It was very, very strange. So the The fear maybe is that he will appoint a political insider, someone from his circle. We even heard there it could be someone like a Donald Trump Jr.
No.
That we couldn't confirm it, but here is the listing. I'm going to post it in the chat. The deadline is February 19th.
Okay, February 19th.
Yep, so
That's plenty of
Jen
time.
is really hopeful he's gonna get a job offer.
Yeah. By the way, I'd only charge 5 bips. 5 bip for it.
there you go.
Trust me,
Hopefully,
you guys don't
hopefully
want to live in
everyone.
Tallahassee.
Yes, yes. So we wrote that story. It came out yesterday or today. And you know, hopefully they pick someone who actually knows how to run money. You know, we'll see. But you know, the fact that he is a likely GOP candidate for president probably means that he will use this as a platform for his, you know, anti-woke, anti-ESG agenda.
So explain something. And I know I should know this. And of course, if Danuta was here, he'd tell me exactly the answer because he's all knowing. But and I say that sarcastically, you know, for the recording. How is it that the fiduciaries out there aren't more accountable? I mean, that to me is it's just crazy. I mean, I don't want to get into the whole Madoff thing, but I know for damn sure that there should be some accountability at the FTX level, and at least just visiting the office or shaking the hand of the CFO. I mean,
Sure.
I don't understand why people aren't going to jail as fiduciaries.
That was my question. I mean, I was stunned to learn that Sequoia Capital gave FTX over $200 million and had never actually visited the headquarters in the Bahamas. Like, come on, get your office to pay for that trip.
Who wouldn't want to go?
So that was, I mean, I was under the impression that when you're putting other people's money to work, you do a modicum of due diligence. Someone explain it to me. Someone on this call.
But one thing you said pre-call that really resonated with me is that like there's a whole batch of new investors, right, that are new to the market. We can talk more about how they came, but like maybe it's just that every 10 to 15 years there's a recession, and every 10 to 15 years there's a new batch of young investors who are like on to the next scam, whatever is coming on. Like, is this just a cycle that we should expect to see, almost like a recessionary cycle? And I mean, it's probably very much correlated to the two, right? Because that's the moment in time. Maybe it's like, this is a good indicator. Like when the fraud comes out, you're 3 months from the bottom. Like that might be
Right.
the indicator. So
Right, exactly. No, it's a great point, because it's like a whole new slew of uninitiated retail investors, but you know, they were like we were saying, they were coming in on their phones. They were, you know, it was the pandemic. They were doing like fantasy football, sports betting, and then they just switched over to, you know, buying AMC and GameStop. It was like it's just an app on your phone. It's just a game.
Well, okay, so DeSantis just posted, right? The job opportunity.
Yep, it's in the chat. So
it's in the chat.
Send in your resumes.
And yeah, I don't see in the chat, but that may be my own
I sent
handicap.
it to host and panel. I don't know if I can post to everybody.
Yeah, okay, I see it.
Dan doesn't want the competition, Erin, so let's just leave it in host and panel.
Nobody else can see it. Is that?
No, no one else can see it. So if you can retype it.
Yeah, but I don't see where it says everybody. That's the problem.
I'll take a look.
You guys deal with it. So how come, is it the SEC? Is it just a government body? Is it, I mean, it just seems like somebody should be accountable. Maybe the voters vote them out if it's not done right. I don't know, maybe there isn't an answer except common sense.
I mean, you mean in Florida?
Yeah.
I think he's very popular there. He has made a career out of going after BlackRock, going after Larry Fink, going after ESG, with particular ire reserved for BlackRock. Although, strangely enough, a lot of the other managers that Florida uses also use ESG. So I think he's a very convenient target.
Okay. Okay. That's fine. Okay. Let's
Someone
see.
typed
Where
a
do
question in asking about the FTX situation. Do you see that?
well, I
Is
see.
that something that you are following closely? Are you working on that kind of
Yes.
in an investigative position? I mean, how
Yeah.
are you going about that?
So this gentleman, I believe, asked, do you think the FTX situation has anything to do with the 100 million plus shorts on MMTLP NextBridge? This is what we were discussing before, sold by hedge funds and brokerage firms. It said they were supposed to be covered by January 19th and still have not been covered. So Dave, maybe you can explain that.
I see. Is this a specific stock you're talking about? Sorry, I'm a little
Yeah,
confused.
I mean, it's one stock that a lot of retail investors were in and they believe, was short squeezed. But I think the synthetic shorts could be much, much larger than just that company.
I mean, they could have. I'm just not sure what platform those synthetic shorts are trading on, right? Like the whole question of the SEC is really like, should they be mandating the crypto markets or not, right? So them making a decision, it's kind of like in no man's land. So this was like the perfect environment for this to happen. But do I know if there's still other platforms out there who are allowing these synthetic positions? I mean, I'm sure there are. I'm sure Binance might be doing some, but I don't know for certain.
Right.
But no, I can't comment on this one specific position, unfortunately.
Could you explain maybe to me and everyone else how these synthetic shorts are constructed, like with how they would be constructed using token as collateral?
Essentially, you buy put and you sell call and you leverage up, right? Like options are a leverage way to do it. And that's how probably the platform, they created a synthetic short stock through the use of options would be my guess. Maybe there's more complicated ways to do that as well that I'm not aware of, but that would be my guess as to how they would go about doing that.
Okay, cool.
Or just a naked short.
That's
No,
right.
because you have to record a trade, right? The whole problem is these are liquid securities.
No, but they're not recorded trades. That's the thing.
Yeah. So probably through the options markets, or I mean, honestly, on blockchain, you can make teeter-totter shares. This is something that Mike Nudo talks about all the time. So as long as there's a buyer, so like you create one long share and one short share. As long as someone wants to hold the long, someone else holds the short, right? And so you almost create synthetic stocks as long as it's matched one for one. And you need some mechanism to balance that out with the actual stock market, because you're not always going to be trading at the same. There's not going to be as many equal buyers and sellers at each price on your platform versus the market, and that's where it gets a lot more complicated. But I mean, truthfully, the talents of the ETF market makers of the world, I'm sure can figure out how to do that. And so you're creating almost like phantom shares of this and trading and offering it on both sides. And as long as the platform is secure, that's actually not terrible, right? But in this case, the platform wasn't secured and investors don't own their own individual assets, as we talked about, because the whole platform was leveraged on a platform level basis. So
yeah, and if the collateral was FTT or some other token, my question is like, how are they going to figure out who was holding all those positions? So
Eric Connolly has a question. Eric, do you want to mute yourself and ask a question? Or you want me to? Okay, I think he's saying I can. Has the SEC improved their trip line is the question. Markopoulos, and I know who he is, I just can't pronounce his name, was all over them on Madoff, and a medical resident tripped them to FTX. I don't know about what he's talking about.
Oh, it's a tip
tipping
line.
Yeah, tip line when you want to report.
Tip line. Sorry, Eric.
No tripping, just tipping.
That's a good question. Yes, the tip line is pretty good. And they do pay a lot more attention to it. I didn't know about the medical resident. So Eric, if you know anything about that, let me know.
It may have been a typo.
No, it wasn't. There's a medical resident who had traced a number of FTX transactions on the blockchain and figured out they were moving money back and forth between Alameda without any customer flows. Hit the journal maybe like a couple weeks ago.
Okay.
But it's literally a guy who works, 100 hours a week in the hospital doing this on his free time.
Wow. Okay. I want his brain. Well, if
A
you
real Michael
remember
Burry
his
type.
name, send it to me because I want to call that guy. Yeah, so I don't know if anyone watched it yesterday. The SEC, Gensler, and 4 or 5 of the other commissioners had an open live conference call a Zoom call to discuss unregulated shorting. That makes me think that they have a handle on what's going on with FTX and, some of the hedge funds and maybe the banks that were using these platforms because they were very specific about it. Were they ahead of the pack? No. But Gensler does have a background in crypto. He was like a crypto chair at MIT. I don't think he actually I think he's willing to let the CFTC regulate it, but I think he wants it to be on his terms. Because as we all know, they should be one agency, but they aren't. And that will forever be the case.
Well, doesn't he have like an ambition or goal of political office or someplace in the government?
Gensler?
Yeah. That's what I hear. Maybe he wants to manage 230 billion. I don't know.
My understanding was that he always wanted to be the commissioner of the SEC. That was his dream goal. What have you heard?
Treasurer.
Interesting. Okay.
Yeah.
I actually thought Larry Fink was gonna gun for treasurer.
I did too. Yeah, that's fair.
But very well could happen.
Both of them could be. I personally would have more confidence in Fink, but
yeah, and Gensler, he and Fink have both made a lot of money, but I think Gensler is a huge Democratic donor. He was very, very tight with the Hillary Clinton campaign, and of course with Biden. So who knows if the Democrats stay in power, maybe he will.
And Gensler, if you're listening, I'm a fan. Don't misunderstand. I'd vote for you. I want to get in trouble.
Someone just wrote in on the Q&A, George Santos will get the job in Florida. Lots of experience with pretty much everything. Very funny.
So,
do you guys want to talk about the LIBOR, the work you did on that, Erin? Tell us about the book and what you found out and how you found out all the juicy stuff.
Oh my goodness. Okay, we're going to keep it really short because we will bore everyone to tears with LIBOR. Let's just say that it turned out that during the financial crisis, the LIBOR was being juiced by the banks. And the way it was set is actually bizarrely antiquated. They pretty much just got on the phone every night and said, what's our overnight rate going to be? And it was an estimate. It wasn't even based on real trades, if you can believe that. So it's since been replaced by the SOFR. The transition has been really, really rocky. I don't really know how vast the adoption has been, but since then, only one guy actually went to jail for the LIBOR manipulation, which, when there's a conspiracy to defraud, there usually has to be more than one person. But as I said before, LIBOR I found it really interesting. I'm a nerd. Even my mom didn't read the book. But But it was also at a period when the central banks were slashing rates, and so I think that's why it started popping up on the radar.
Yeah, we're glad you're not into like, sales and promotional stuff too, because you're killing yourself on the book.
Yeah, sorry. The name of the book on LIBOR was called Open Secret, because it pretty much was an open secret that LIBOR was an engineered number. It wasn't based on real trades, and that was fine until a crisis arrived.
So Erin, twist it around though. I mean, these were regulated enterprises, right? The banks.
Yep.
How come that can happen? Isn't regulation the solution for everything? I mean, everybody says that's the case for crypto.
I mean, you cannot legislate good behavior.
No,
That's always my answer.
That's true.
Yeah, I mean, the banks paid billions of dollars in fines. Citi, RBC, Rabobank, a bunch of others. But those are the cost of doing business, right?
It's kind of like fines, like in the tech industry, they pay it, their stock price goes up because they're like, that's in the past, right? Like that's over, time to find the next thing, right?
Yeah.
So where does that, I've always wondered, where does all that money go to? Does it go to?
It actually goes to the Treasury. Yeah, they get a big fat check, and then if there are civil suits, class actions, and they win, then the investors get some money back. But for the most part, yeah, they go to the U.S. government.
Does it get isolated to, pay people to do more investigation or
to like fund the SEC or the IRS or any of
Some,
the regulatory agencies that really need it? I doubt it. I wish I knew. I don't know.
the next book?
Yes.
Where did your money go?
But that's a great question. I never thought about that, because so if the banks misbehave, it potentially hurts people on the street, like using the LIBOR for stuff. And when it comes to restitution, the money lands on a government account. Because if you go in a civil suit, then the banks are out for reparations in court, right? So the banks could end up paying twice. So it's almost like maybe that's why regulation doesn't catch this stuff, because the penalties actually benefit the government in the end, right?
Maybe, yeah.
It's a conspiracy theory.
It's like a, it's like they're like a toll taker, for bad behavior, right?
In theory, the whole thesis of banks is to separate the entity that deems and decides who is worthy of credit, right? Like that's the whole thesis of keeping banks separate from governments. So like, it's not the government's saying you deserve credit at this rate and you don't, but how separate do you feel the banks and the government are in our society? Is what I would say. So
it's funny you mentioned that, because so for instance, I would say right now, actually, other than Wells Fargo, which I think more than one fund manager has called a criminal enterprise, the banks actually stopped doing a lot of the lending that now the hedge funds and the private credit market, which they've stepped into the breach. That's all we hear about at my current job at Pensions and Investments is private markets. The 60-40 is going to be replaced with 40-30-30. 40% stocks, 30% bonds, 30% private markets, if you can believe that.
No, I don't believe that.
Well, it's happening.
Alternatives.
Yes.
Seriously?
Yes.
That's just a license to steal and just say, I want to price things the way I want.
I mean, this is, I guess it's the, someone just asked about LIBOR completely phased out with SOFR in 2023. In theory, yes, but it's probably actually taking a lot more because there were so many securities that are still tied to LIBOR. So, but to answer the question, what was the question?
Well, it was, it was more of a
But I
stick.
guess 40, 30, 30, if that's just going to be a license to steal.
Oh,
Yeah.
right.
Can't put it.
I
That's a
mean,
statement, by the way, more than a question.
I mean, look,
So-
I don't know about the rest of you, but like, I am always very uncomfortable with private equity having such a lag in reporting their returns.
Mhm.
It's a lack of mark to market, right? And so
Correct.
a lot of these big banks play access as a way for them to do business. So they're like, we are the only way you can access this investment. And then they get all the large institutional and individual investors open up accounts there. And then every once in a while it bites them in the butt, right? Like, so JP Morgan in 2020 and 2021, their big push was like, we got exclusivity in Tiger Global. We're the only way you only private bank you can access Tiger Global from.
Right.
So all the big money was like, let's go to JP Morgan, let's get access to Tiger Global's newest and greatest fund. And we all saw how last year went with that asset class. But yeah, private is a game of exclusivity. So even
Right.
if it's not the best portfolio, it's like it's how they put their wide moats up in terms of their offerings. So, but that's the beauty of the ETF space, which Jonathan just commented in the space, is that, like, to my knowledge, there's no frauds in the ETF space because it's fully transparent on a day-to-day basis for the most part, minus some non-transparent ETFs that take up a very, very small portion of the overall assets. Here's the one still trying, but
Yep. A very smart person just posted something in the chat saying Dodd-Frank moved a lot of financing from traditional banks to shadow banking with less oversight. And that's exactly right. Someone asked me, well, first of all, is everyone going down to Miami for the big ETF conference?
We are.
Yes.
Full
Okay,
force.
good. Yeah, what we
Are
have
you going to be
someone
there?
down.
Oh, you're going to be there.
No, actually, our reporter Kathy O'Donnell is there. So if you see her, grab her and say, we've got stories to tell you. But someone actually asked me if they thought private equity would ever have an ETF. So I posed that question to you all.
say,
We're willing to do anything, but it's got to be liquid.
synthetically, potentially on like an asset class level basis, individually, probably unlikely because of the liquidity needs. Closed-end interval fund is much more likely for that kind of asset class in the marketplace.
And how do you get transparency?
On the private equity space, I mean, they're not going to give it to you, right? Like they don't care about retail allocations. They care about the pensions and institutions, right? That's the real money that they're going after. They need 100 close relationships instead of a whole bunch of retail relationships. So it's really hard to get transparency to that whole industry. And there's no way to mark to market. Like, look at Blackstone's REIT portfolio. If you saw what happened with BREIT, just to rephrase in a very, very quick format, took in $50 billion, $125 billion largest private REIT, taking in inflows in Q3 in 2022, posting positive 9% returns as of Q3 2022, met their gate redemptions over 5%, tried to redeem in fourth quarter. They put the gate up. So obviously only people got a percentage out. And then they went to the state of California and offered them an 11.25 preference on 6 years to give them some liquidity to meet future redemptions, so they don't actually have to sell anything and mark their portfolio to market by selling things, taking away all upside from the investors. That should be, I mean, that's borderline fraud in my opinion. So I'll stop the reading after that. But
Cheers.
Yeah. I do know that some private equity funds are actually traded on the blockchain.
Oh, really? Like
Yeah.
which ones?
I know Apollo has a couple, and KKR too.
How
I'll
does
say.
that work? How does that work?
Don't know the answer to that. Good question, but I think it's basically there's an offer, there's a bid. I don't know how wide it is, to your point. I can put you in touch with the people if you want.
Oh, that'd be great. Yeah, that's
Cool.
very interesting.
okay, close-end
Daniel.
fund.
Daniel
Yes.
Santiago's got a question. He's been waiting very, very patiently. Thank you.
I do. I have a question for you, Erin. Nice to meet you virtually. So this is kind of a boring question, building on your LIBOR work. I want to ask your opinions about what is going on in the overnight repo markets, right? Where the banks
Yeah.
score up with each other at the end of the day. I noticed that it peaked on the last day of 2022. So I just want to hear your thoughts.
And okay, explain it to me again.
The overnight repo markets.
Mhm.
So it's where the banks square up with each other at the end of the day. And essentially it's the Fed pumping a ton of liquidity into the markets overnight to the banks.
Okay. And you're asking why was it bid up at the end of
Well,
the
I
day?
just wanted to know, you wrote a book about the LIBOR, you talk a lot about the SOFR. So I just was asking if you had
okay.
any thoughts.
Man, you are assuming so much more knowledge on my part than I actually have. So my understanding, so let's just, for example, I just interviewed a hedge fund manager who he does loans to law firms. It's litigation financing. Oh, thank you for the message.
You're welcome.
And he is now using SOFR to price his loans. He has outstanding loans from a couple of years ago that are still set to LIBOR, but it is slowly transitioning. The banks themselves formed the committee for this transition, and they have dragged their feet for several years now. I mean, you can understand why, because it's very, very difficult. I think the number that I used in the book, the notional value was 300 trillion of debt that was tied to LIBOR. I mean, think about all the student loans and the credit cards and, everything, mortgages. So there's, it's just going to take a very, very long time. And thank you for that link.
Thank you.
Michael, you want to jump in and ask your question?
Yes. Hi, Erin.
Hi.
I recently watched a Netflix series about Bernie Madoff, and I think that was very good. What did you think about JP Morgan Chase and no action being taken on any of their role in there?
Okay, so the background to your very excellent question is that for those of you who haven't read the book or aren't familiar with the Madoff situation, he had this Ponzi scheme that at its end totaled up to about 60 billion. That included all the phony profits that had been accruing over several decades. He never made a single trade in that hedge fund. There was zero trading taking place. He was wiring money back and forth from his JP Morgan, well, at the time it was Chase bank account, to his London accounts, and then wiring it back to make it look like there was trading going on. Pretty messed up. So at any one time, Chase, which ultimately became JP Morgan Chase, saw that he had this checking account with $1 billion or more in it, just sending money back and forth, and in size that should have triggered a suspicious activity report, but never did. I've always assumed that JP Morgan knew what was going on, because not long before he was arrested, they got all their clients out of Madoff's funds. But I have to be very careful so that I don't get sued to answer your question, Michael. So yeah, they knew what was going on.
Thank you.
Sure.
And I wonder if that's just, if we assume for a second that they really knew what's going on, which suggests some level of complicity by lack of action, it's just, isn't that just a basic story of incentives? It is, people act based on incentives, which is why these conflict of interest and all these things are in the world we live in, and in wealth management, all that are so important, and transparency is so important. Yes. Because at the end of the day, incentives are what drives a lot of these decision making, and I guess, poor behavior too.
Yes, I mean, JP Morgan and a lot of other banks were selling, investments in Madoff through leveraged notes. I mean, David, you can talk about this. Tell everybody what you told me.
Yeah, so I was a rookie. It was like spring 28, and I was working for a broker dealer. We had a couple hundred advisors, and I was head of due diligence. And an advisor brought us two different offerings investing into Bernie Madoff's hedge fund. One was a direct investment into it, and one was a feeder fund that took the assets, leveraged it 300%, and then invested in Bernie Madoff's funds. Because, like, why wouldn't you want to add leverage to something that was like that consistent? So they had the best seats at the US Open by far. But yeah, and honestly, I think in terms of like incentives, you could even look at what happened with like WeWork. Like, all the banks were legitimately ready to price WeWork's IPO at like this like insane valuation, because they already had equity there, and it's so much debt that was tied to that equity as collateral that like they were better off just being like, let's just see what the market says, right? And I think that's, similar concept of maybe you have to really look under the hood and see what their overall incentives are.
Yeah, so I hear a lot of this. So back to FTX. We know of, I could list 10 venture funds and, private equity funds that have invested directly in FTX. Sequoia, SoftBank, Institutional Venture Partners, Rivet Capital, so many. So now that they've had they have egg on their face, having put money with this fraudster, cheers. They're now going back to their clients and saying, oh, by the way, we know you're upset about this, so we are only going to charge fees on capital that is deployed instead of the entire amount of capital that you've given us, which I always thought was kind of a shitty deal myself. But what do you make of that?
I personally agree. It's a shitty deal.
Well, if you want to talk about how rigged the game is, so if you're a big private equity firm, I think one of the craziest things you can do is so usually they have call features, right? You don't give all the money up front. It's like they'll call it over some multi-year period, but the private equity firms and hedge funds can go to these banks and leverage the entirety of the to be called capital and play around with leverage on like all this uncalled capital based on the balance sheets of these individuals who are offering this. So it's kind of crazy. So that's why I always say, like, it's the length of a recession more than the depths of the recession that matter, because it's like these ticking time bombs of leverage and debt. And it's like, as long as the music doesn't stop for too long, they've geared it up enough that they're going to be okay. But it's like it's too long that like then the wheels start falling off.
And isn't that the reason why people are becoming more optimistic about the overall market? Because if things might have bottomed, it was a short period of time, the damage will not have been that bad. And, we'll have unemployment a little bit higher, we'll have inflation a little bit lower, and we can have optimism back. So I definitely wanted to pick your brain on something different. But Elon Musk, of course, is always controversial. As an owner of Twitter, he's got his own agenda. You're pretty big user of Twitter. I mean, at least you are active in it.
Yes.
Since he has acquired the firm, have your views changed as to the experience?
Yeah, I mean, I get a lot of like weird, requests for dates. But,
she's married, by the way, in case anybody.
And I would say definitely the platform itself is not as fun or as open as it used to be. But here is our dilemma. I would say, as a member of the media, we must engage on every platform possible. You know, whether it's, I mean, I'm still on LinkedIn. I post my stuff on Facebook. I put it on Reddit. I put it out in as many venues as we can, because we're trying to reach as many people as we can. So we are forced to use what's even like a really kind of crap platform. Do I think Elon Musk is a visionary with electric cars? Yes. Do I think he knows how to run Twitter? Probably not. But I'm still using it because I have to. How's that?
Yeah, no, that's fair. I mean, I actually use it too very frequently. I use it actually as a source of information.
I get a lot of tips through Twitter. I get a lot of tips. A lot of people who might not otherwise, you know, contact me because they want to stay anonymous. And, you know, I've met some very interesting people. You know, I get to do fun stuff like this.
Sure.
So.
Well, you answered the question. And by the way, the banks are on the hook for like what, $13 billion.
Yeah.
So we hope them well in Twitter
luck with
being
that.
successful.
Yeah.
Yeah. So yeah, do you spend a lot of time on Twitter?
I am on it probably. I actually went back and looked at like how many posts I had done since I got on it. It was like 25,000. That's over the last 12 years. That is why my attention span is so short. It definitely changes your brain. But you know, we're also, we do try and reach grownups. We post our stuff on LinkedIn. I really like Reddit. It's a great way to kind of go down the rabbit hole.
Yeah, I don't use Reddit.
But yeah, I'd be curious to hear what you read, you know, where you get your information. I'm always curious to hear that.
I get a good amount of information on Twitter, definitely on LinkedIn. I also get a great amount of information. It also allows me to share information, get feedback, which I appreciate. Those are my platforms that I use. I don't use anything else.
How about the rest of you? What do you use?
I read
Yeah, no, I was just gonna say, I just read other news platforms like all day long. Like I'm constantly on Market Watch to see where the market's at, and I read all the other financial news platforms and regular platforms and Wall Street Journal, all that stuff. So I'm constantly reading things that pop up.
You know,
I lean towards Bloomberg.
You like Bloomberg? Yeah, me too.
I like Bloomberg. I like Financial Times. I think a lot of podcasts and Twitter Spaces are really good. I think actually, you know, obviously getting a feel for what the granular news source is saying and what the research reports coming out of Wall Street is important. But to Dan's point, right, like Twitter Spaces is not technically news unless it's repurposed. And I actually think you get a lot more interesting information from people before it's filtered down by a compliance officer somewhere. And you get a little bit more of their kind of raw emotions and thoughts on the whole thing. So I do think it's a good source of like tips as you lead to.
Right. Yeah. And a lot of times Twitter will lead me, like someone just said, Substack newsletters are good. And a lot of times I will see someone's Substack on Twitter and I'll go read it or subscribe. And but yeah, I mean, we have to keep up with, you know, the Journal, the Times, Bloomberg, and then, you know, gazillion podcasts and Twitter. So I'm on it all day long.
Nobody mentioned CNBC. Was that coincidence?
I mean, do you have it on in the background?
No, I don't. I don't. I'm not good at multitasking. So if I'm hearing that, I'm not concentrating. Just a weakness I have.
Sometimes they will get, they get a lot of, well, what we call a get in the industry. You know, they will get a sit down with Larry Fink or Jonathan Gray from Blackstone, or, you know, the CEOs. We never get those. But CNBC can also be a very friendly audience. So,
But Larry Fink doesn't bring stories on CNBC. I mean, it just,
I mean, he said the other day that he thought the whole ESG attacks had become very personal, and that was on CNBC.
and is that news? I mean, honestly, they have been personal at him.
Yeah, but
that
that was the
wasn't-
first time. That was the first time he actually admitted it.
Oh, so he was upset that it was personal. Okay, I get that. That's fair. That's fair.
But yeah,
He should try Spaces.
we did ask. Some people here quoted in the chat, Globe and Mail, love it. Oh yeah, the Federal Reserve website, Liberty Street, I love that blog. It's the Fed blog. And CNBC equals financial pornography.
So, but to talk about the idea of personal, because Larry Fink, I was just thinking like, and all your work, like when you did the Bernie Madoff investigation, I'm guessing with LIBOR was the same thing, and what you're doing now with FTX, you interview a lot of the people who are actually impacted by all this fraud and these scams. So, as you look back, like, are there any interesting stories that really stuck with you, either as a big like lesson learned or something that, I don't know, just really stayed with you that you applied to other things from people's personal experience from being caught in these situations?
Yeah, sure. So, I mean, and I said this in the, in the Madoff monster movie, as I call it. The main thing is that if something doesn't feel right, like in my gut or in your gut, like if you're thinking this doesn't feel right, there's something, off, then like stay away, run in the other direction. I can't tell you, like I've talked to several investors in, some of these short squeeze plays or like GameStop and so forth. And many of them put like 50% of their net worth into one stock. That's, I don't know who to blame for that, but
Himself.
Yeah.
Yeah.
I don't judge because, a lot of us are not educated enough to run our own portfolios. That's why ETFs are so great, PS. So that's one thing. And then the other thing is like the title of the book. If it's too good to be true, like, don't do it.
This is true. We're at the top of the hour. Erin, this has been really wonderful.
Oh yeah, it's been terrific. Thank you for having me.
Watch out for frauds, everybody. They're out there. They're probably
Yes.
too good to be true, right?
I am on LinkedIn, I'm on Twitter. Feel free to contact me. I'm a real person. I'm not a chat bot. And Dan, thank you for having me. Dave, Cynthia, everyone, thanks for listening. An hour of your life is a long, long, long time in this era. So thank you.
It was wonderful to meet Patrick. Congratulations.
Yeah. Oh, PSP is one private equity ETF.
I'll argue with Lily about that.
Lily, call me, Lily.
It's an ETF of the private equity companies. It's not a private equity. It's not an ETF of private equity holdings. It's the equity behind the private equity guys. So
Understood.
And BDCs too.
Right.
Yeah. So anyway, I actually think that was a little bit of a fault on the ETF market, which to some degree, because the people involved in the ETF market self-regulate when things are wrong. Labels can be misleading. And when that came out, it was at the peak of private equity. Yep. So it was an opportunity to promote, Anyway, thanks everybody. It was great. And I'm sorry if I didn't get the technology right. I know there were some issues. So we'll see you next week.
See you next week. Thanks again.
Thanks, everybody. Have a good night.
Thank you.
Bye.